The CPI is propaganda. It's not a number that accurately reflects inflation in the economy. Core inflation excludes food and fuel. I eat. I drive. That number doesn't impact me. The CPI doesn't include tax, despite the fact that for the average American family, the cost of tax exceeds the cost of food, fuel, and shelter and transportation combined. So an inflation number that doesn't include the cost of government is a specious number to begin with. What it's useful for is manipulating sentiment. So the fact that CPI, which is in itself a meaningful number, is declining, ironically has a big impact on the market. If you look at the arithmetic behind the narrative, what you see is that the CPI number is still above 7, and the nominal interest rate expressed by the US 10-year Treasury is at 4. What that means is that savers in our economy lose 300 basis points of purchasing power a year by owning savings instrument. That's important, but it's important in the 2 to 3 year time frame. What you have is 100 million morons out there who think that over time, the actions of the Fed or the CPI, in itself a floating abstraction, is a fundamental. It's not. It's a momentum narrative. For people who are traders, they are going to have to involve themselves in trying to extrapolate the value of competing narratives on a market. To me, that's a fool's game, perhaps because I can't do it.
Have you ever traded or invested through a period of falling CPI but rising gold prices? And what do you make of it?
Yes. In 1975, when the US Fed raised interest rates aggressively, the back half of 1975, the market came to understand that there was a lag in terms of the economic response to rising interest rates. And I think people are looking at least at the United States economy and saying that although the economy has weathered interest rates so far, to the extent that nominal rates stay as high as they have been, that the impact of rising interest rates will begin to be felt in the US economy. So I think in terms of US institutional demand for gold, which is fairly strong right now, that there is an anticipation on the part of institutional investors. Well, first of all, that the impact of higher interest rates on the economy is lagging. In other words, that the impacts will become increasingly severe, and that the Fed will either halt the increase in interest rates or in fact pivot and decline and have them decline. I think that central bank buying is easier to understand. And I think that comes around two things. The first is that traditionally their safe harbor was US Treasury securities, foreign central banks. They now understand the arithmetic around that. You are buying yourself a 4% yield in a currency where the purchasing power is declining by 3%. In other words, you are guaranteeing yourself a 3% loss. If the job of the Chinese central bank is to provide an underpinning for the Chinese economy, a 3% compound loss over a decade means that they've lost a third of their purchasing power in a safe haven asset. That's pretty simple arithmetic to understand. It's compounded by the fact that many societies around the world oppose the export of US values and the weaponization of the US dollar. It's fairly clear, I think, to the Chinese, to the Iranians, to the Russians, to the Venezuelans, but to other countries as well, that to the extent that they conduct all of their business in US dollars through the SWIFT banking system, that the United States government can punish them in economic ways, pursuing their own self-interest. It's also true that despite their pronouncements to the contrary, Saudis don't trust the Chinese don't trust the Russians don't trust Venezuelans, that the US currency market and treasury market is the deepest, most transparent, most liquid market in the world. And that increasingly trade that bypasses US hegemony will have to be conducted in gold. I'm not talking about a gold-backed currency. I am talking about using gold as a payments mechanism to cover the surplus of trade denomination that doesn't occur in what is effectively barter, which is to say that if the Chinese buy Russian oil, to the extent that there is a surplus or deficit in trade, which is to say too many or not enough Chinese goods go to Russia in exchange for the oil, that the difference, which used to be transacted and stored in US dollars, will increasingly become transacted and stored in gold. I think that gold fulfills a different purpose. So I think that there's much stronger demand for gold than there is for uranium. among the very, very, very large investors. We talked about central banks. Let's assume that Stanford University is a central bank right now, just for a second. A great big institutional investor with an endowment of, I don't know, 25, $30 billion. And the requirement with regards to that endowment is that they serve the needs of students in the university 20 or 25 years from now. Traditionally, great big endowments like Stanford have had 60% of their assets in debt securities, very stable securities that provided them safe harbor in periods of tough equity markets. Now, 60% of their portfolio guarantees them a loss of purchasing power. Disintermediation is occurring in the long bond market, and gold is getting a fraction of the flows, but it's getting a fraction of the flows on a corpus of capital that is so enormous that if you assume that gold is the beneficiary of 0.5% of the flows, and I don't know what the number is, I'm extrapolating gold's market share in total U.S. savings and investment assets, which is 0.5%, to suggest that perhaps gold gets 0.5% of the flows from disintermediation from the long bond market. Because it's such an enormous amount of money, that small piece of demand against a large amount of money has an outsized impact relative to the very small float of gold relative to other financial assets.
What type of companies are you looking for in this environment, in this stage of the bull market? Is it higher risk explorers? Is it the lower risk royalties?
Yeah.
What are you looking for?
You know, Antonio, the last 5 years that you and I have talked, I've talked about erring on the side of caution, that bigger, better companies were attractively priced compared to the speculations. Now we're seeing a circumstance where people who bought narrative for the last 5 years are disgusted with narrative. And so they're selling the riskier stocks. And so I'm buying them. While I believe, as an example, that the move will occur first in gold, people hate silver stocks because they've lost so much money in them in the last 5 years. So I'm moving into the silver stocks. People hate exploration because exploration hasn't worked for them for 5 years. They had visions of tenfold gains, and instead they had 75% losses. And they blame the exploration sector rather than their own stupidity. And so investors are throwing the babies out with the bathwater in the exploration sector. And I'm looking now to participate in private placements for capital-starved explorers that have done good work when nobody else will give them any money. I love the way the uranium stocks are acting, which is to say they're falling, because they're coming towards my price targets. I think for myself that we're coming into a real risk-off market, because in my heart of hearts, I think that there's a likelihood of recession. In risk-off markets, I go risk-on, not because I think that if I buy a stock for $1, it'll go to $3 this year. It might fall to 70 cents. But when I buy a stock for $1, what I'm looking at is what it might be worth 10 years from now or 5 years from now. And the idea that I buy a stock for $1, it falls to 70 cents, and then it goes to $10 is not an unattractive proposition.